Did you have any idea that this was coming?
No.
From the Pulaski Savings Bank, which closed its doors at the first quarter of the year, to the First Republic Bank, which positioned itself as the premier bank for wealthy clients and successful technology firms, 2025 is shaping up to be a brutal year for U.S. banking. In this video, we're breaking down the list of banks that experts say may not survive the year and what you need to know before your money is trapped. Let's begin with the first on the list. Pulaski Savings Bank. Pulaski Savings Bank, once a stalwart financial institution in Chicago, became the first casualty of 2025 when it abruptly closed its doors on January 17th. With $49.5 million in assets and $42.7 million in deposits, this single branch bank's collapse might seem insignificant in the grand scheme of things, but it signaled something far more concerning. What few people realize is Pulaski's heavy dependence on commercial real estate loans in a struggling Chicago market. As remote work became permanently entrenched in corporate America, the bank found itself holding loans against increasingly vacant office buildings, properties worth a fraction of their pre-pandemic values. The FDIC estimates place the cost to the Deposit Insurance Fund at approximately $28.5 million, a staggering 57% of the bank's total assets. Industry analysts point to suspected fraud within the bank's loan documentation as a contributing factor, highlighting the dangerous combination of market pressures and internal control failures. Millennium Bank stepped in to assume Pulaski's deposits, ensuring customers maintained access to their funds. But for the small Polish-American community the bank had served since its founding in 1889, the closure represented the loss of a financial institution that understood their unique needs and history. For elderly customers who had banked with Pulaski for decades, the transition meant learning new systems and building relationships with unfamiliar bankers. Small business owners faced disruption to their credit lines and checking services during the transition, with some reporting delays in processing transactions that impacted their operations. Why should Americans be concerned about the failure of a small Chicago bank? Because Pulaski represents the canary in the coal mine, the first visible indication of a widespread weakness lurking across the banking sector. If a bank this small and seemingly conservative could collapse this quickly, which institution might be next? As regulators scrambled behind the scenes, another bank quietly fell, this time in rural Oklahoma, and that is the First National Bank of Lindsay. On October 18, 2024, the First National Bank of Lindsay in Oklahoma shut down after 122 years in operation. This historic institution, with $107.8 million in assets and $97.5 million in deposits, had been a fixture in the small farming community since 1902. The hidden connection most people don't understand is Lindsay's excessive exposure to agricultural loans in a region devastated by recent climate events. Combined with suspected fraudulent records uncovered by regulators, this created a perfect storm for failure. During its final examination, regulators discovered that over 70% of the bank's loan portfolio consisted of agricultural credits to borrowers within a 30-mile radius, an extreme concentration that left the institution vulnerable to localized economic or environmental shocks. When severe drought conditions persisted for 3 consecutive growing seasons, loan delinquencies surged beyond sustainable levels. The FDIC estimates the cost to the Deposit Insurance Fund at approximately $43 million, indicating significant asset quality problems that went unaddressed until it was too late. Industry analysts note that the bank had been under a confidential regulatory enforcement action for nearly 18 months before its ultimate failure. First National Bank of Garvin County assumed Lindsay's deposits and purchased a portion of its assets, maintaining financial services in the community. However, the acquiring bank's more conservative lending standards meant many farmers who had relied on Lindsay's flexible approach to seasonal financing found themselves unable to qualify for equivalent credit facilities. The impact rippled throughout Oklahoma's farming communities, where generations of families had relied on the bank for everything from equipment financing to home loans. Local farmers suddenly found credit lines frozen, with devastating consequences for seasonal planting. A fifth-generation farming family that had banked with Lindsay for over a century described feeling abandoned. They knew our cycles, understood that some years you need more time. The new bank just sees numbers on a spreadsheet. What makes Lindsay's failure particularly significant is how it highlights the vulnerability of specialized agricultural lenders in an era of increasing climate volatility and agricultural consolidation. As extreme weather events become more frequent and severe, how many other community banks serving rural America face similar hidden risks? And the warning signs didn't stop there. While Lindsay's collapse exposed rural banking vulnerabilities, the fall of this next bank revealed just how fragile even the smallest community-focused lenders can be. Resolute Bank. Resolute Bank collapsed on October 25, 2019, with just $27.1 million in assets and $26.2 million in deposits, making it one of the smallest bank failures in recent years. This Ohio-based institution focused primarily on residential mortgage lending in underserved communities around Maumee. The critical vulnerability few recognized was Resolute's extremely narrow business model and limited capital reserves, leaving no margin for error in an increasingly competitive mortgage market dominated by large national lenders with sophisticated sophisticated technology platforms. Founded in 2012 as part of a brief surge in new bank formations following the financial crisis, Resolute never achieved sufficient scale to absorb the rising compliance costs that disproportionately impact smaller institutions. With just 11 employees in a single location, the bank's overhead consumed an unsustainable percentage of its revenue. What made Resolute unique was its mission-driven approach to mortgage lending in overlooked neighborhoods. The bank had developed specialized expertise in government-backed loan programs designed for first-time homebuyers and historically underserved borrowers. They employed loan officers fluent in Spanish and offered financial literacy workshops for community members. Buckeye State Bank assumed Resolute's deposits and purchased some of its assets, but did not maintain the same community-focused mortgage program. Within months, application approval rates for mortgages under $100,000 in Resolute's former market area had declined by nearly 40%, according to local housing advocates. For low-income homebuyers in Ohio who relied on Resolute's personalized approach to mortgage lending, the bank's failure meant losing a financial partner willing to look beyond rigid credit score algorithms. Community housing advocate Marcus Johnson described the impact. Resolute would sit down with families, understand their unique situations, and find ways to make homeownership possible. That kind of personal touch is disappearing from banking. What makes Resolute's failure particularly significant is how it represents the growing challenges facing the smallest community banks across America. As regulatory compliance costs rise and technology investments become essential, how many other small institutions lack the scale to remain viable in the modern banking landscape? And it wasn't an isolated case. Just as Resolute's downfall highlighted the uphill battle for small-town lenders, the next bank on the list folded the very same day. Louisa Community Bank. Louisa Community Bank in Kentucky failed on October 25, 2019, with $29.7 million in assets and $26.5 million in deposits. This small institution had been founded to serve a rural community often overlooked by larger financial institutions in eastern Kentucky's coal country. What few people understood was Louisa's vulnerability stemming from its founding in 2006, just before the financial crisis, and its struggle to build sufficient capital reserves during the subsequent challenging years for new banks. Without the cushion of decades of accumulated capital, newer institutions face heightened vulnerability to economic shocks. As one of the few de novo banks founded in the region in decades, Louisa represented a significant but ultimately unsuccessful attempt to restore community banking to an area increasingly dominated by large regional and national institutions. Its founding coincided with the beginning of accelerated decline in the coal industry that had historically driven the region's economy. Louisa had developed specialized expertise in lending to businesses serving the energy sector, including equipment repair shops, transportation companies, and retail businesses dependent on coal industry workers. As mining operations closed or reduced operations, the ripple effects through these supporting businesses created unsustainable loan delinquencies. Kentucky Farmers Bank Corporation assumed Louisa's deposits and purchased some of its assets, maintaining financial services in the area, but with less specialized knowledge of the local economy. The acquiring bank's headquarters was located over 40 miles away, and many decision-making functions were centralized rather than managed locally. For the small Appalachian community of Louisa, the bank's failure meant losing a financial institution specifically created to address local needs. Small business owner Robert Anderson expressed the sentiment of many. They understood coal country's unique challenges. Now we're just another dot on the map to some bank headquartered in a city where they couldn't find us with a GPS. Louisa's collapse raises important questions about the future of community banking in rural America. As regulatory requirements and technology costs make new bank formations increasingly rare, what happens when existing small banks fail? Will new community banks emerge to replace them, or are we witnessing the gradual disappearance of truly local banking? And just when it seemed rural banks couldn't take another hit, a decades-old institution rooted in America's heartland quietly crumbled. Heartland Tri-State Bank. Heartland Tri-State Bank in Kansas collapsed on July 28, 2023, with $139 million in assets and $130 million in deposits. This regionally significant institution had deep roots in agricultural communities across 3 states since its founding in 1934 during the Dust Bowl era. The critical vulnerability that few understood was Heartland's enormous exposure to increasingly unstable agricultural lending in regions facing both climate challenges and shifting commodity markets. As farmland values fluctuated wildly and crop insurance claims soared due to extreme weather events, the bank's loan portfolio deteriorated rapidly. Regulatory examinations revealed that approximately 78% of Heartland's loans were in agricultural credits, with particular concentration in wheat, corn, and cattle operations. When severe drought conditions across Kansas, Oklahoma, and Nebraska devastated crop yields for 2 consecutive seasons, loan delinquencies surged. The bank had attempted to address this concentration risk by expanding its commercial lending in small towns across its footprint. However, these efforts came too late to offset mounting agricultural loan losses. losses. By early 2023, nearly 12% of the bank's loan portfolio was classified as non-performing, an unsustainable level for an institution its size. Dream First Bank assumed Heartland's deposits and purchased some of its assets, maintaining branches in most communities served. However, the acquiring institution lacked Heartland's deep agricultural expertise, creating challenges for farmers accustomed to working with lenders who understood their specific operational needs. For farming communities across Kansas, Nebraska, and Oklahoma, Heartland's failure meant losing a financial partner that understood the unique rhythms and needs of agricultural business. Fourth-generation farmer Scott Williams expressed the sentiment of many: the big banks don't understand how farming works. The seasonal cash flow, the unpredictability, Heartland did. Now we're just account numbers to some bank headquartered 1,000 miles away. The impact extended beyond individual farms to entire rural communities. Agricultural equipment dealers reported sales declines as farmers delayed purchases due to uncertainty about credit availability. Livestock auctions saw reduced bidding as operators became more conservative in their expansion plans. The question this raises is deeply troubling. As climate instability continues to transform agricultural regions, how many other regional banks face similar vulnerabilities in their loan portfolios? And what happens to these essential American communities when their financial institutions disappear? But the biggest shock was still to come. As regional banks struggled in silence, one of the nation's most prestigious institutions fell, and that is First Republic Bank. When First Republic Bank collapsed on April 28, 2023, it represented the second largest bank failure in American history, with a staggering $229.1 billion in assets and $103.9 billion in deposits. This California-based institution had positioned itself as the premier bank for wealthy clients and successful technology firms. What few people realized was First Republic's dangerous concentration of uninsured deposits, accounts holding well over the FDIC's $250,000 insurance limit. When confidence wavered amid the broader banking crisis, these large depositors rushed to withdraw funds, creating a devastating bank run that drained liquidity despite the bank's otherwise solid fundamentals.
That's a real casualty of this Fed tightening cycle. So what happened to today? What caused the reversal from a usually green board in the morning to a board that's drenched in red, with the Dow plunging 544 points, S&P plummeting 1.85%, and the Nasdaq nosediving 2.05%? Simple. The bank stocks collapsed.
For thousands of businesses and wealthy individuals, First Republic's failure meant days of uncertainty about access to operational funds. Technology startups with payrolls in the millions temporarily lost access to their capital reserves, forcing emergency funding rounds and layoffs. Perhaps most concerning is how First Republic's fall demonstrated that even apparently healthy institutions can collapse with frightening speed when confidence erodes. If a bank catering to the wealthiest and most sophisticated clients in America could fail virtually overnight, what does that suggest about the stability of the broader banking system? And the cracks were spreading fast as another major institution crumbled, one deeply tied to both traditional finance and the digital frontier: Signature Bank. On March 12, 2023, Signature Bank became the third largest bank failure in American history, with $110.4 billion in assets and $88.6 billion in deposits. This New York-based institution had built a reputation as a banker to law firms, real estate companies, and more recently, cryptocurrency businesses. The hidden vulnerability that proved fatal was Signature's rapidly expanding cryptocurrency exposure, a sector experiencing extreme volatility and regulatory scrutiny. As crypto markets fluctuated wildly, depositors lost confidence and withdrew funds at an unsustainable rate.
Meanwhile, Signature Bank marks the third largest bank failure in U.S. history. Regulators say all customer deposits will be insured in that case as well. ABC's Mona Kozar-Abdi joins me live outside one of those branches in New York City. For more on this.
For small business owners across New York, the impact was profound despite regulatory assurances. One longtime customer named Donald, who had chosen Signature specifically because he wanted to walk into a branch where people knew his name, described his heart dropping when he heard the news. Even with guarantees that depositors would be made whole, the psychological damage was done. A trusted financial partner had vanished overnight. What makes Signature's collapse particularly significant is how it represents the growing vulnerability of banks experimenting with emerging financial sectors. As traditional banking increasingly intersects with less regulated domains like cryptocurrency, how many other institutions are exposed to similar risks that remain hidden from public view? But even that wasn't the first warning shot. Just days before, another giant fell, one so deeply embedded in the tech world, and that is the Silicon Valley Bank. March 10, 2023 marked one of the most spectacular bank failures in American history when Silicon Valley Bank collapsed with $209 billion in assets and $175.4 billion in deposits. This institution had been the financial backbone of America's technology industry, serving nearly half of all venture-backed technology and life science companies. What few people understood was SVB's unique vulnerability stemming from its highly concentrated clientele and investment strategy. The bank held billions in long-term treasury bonds that plummeted in value as interest rates rose, while simultaneously serving a customer base of tech companies that began burning through cash reserves as venture funding dried up.
For instance, we learned today that SVB Financial, that's the parent company of Silicon Valley Bank, had to raise $2.25 billion in one day. That's a tremendous rate, tremendous fundraise. One day! Because it had some very serious portfolio losses. It shocked everyone because this is a very good bank. Not expected to have many problems. I'm used to these guys.
The human impact extended far beyond Silicon Valley. Thousands of startups temporarily lost access to their operational funds, forcing emergency measures including layoffs and project cancellations. One founder described it as existential whiplash, going from building the future to fighting for survival in a matter of hours. Silicon Valley Bank's failure raises the most troubling question of all. If an institution this central to America's innovation economy could collapse so quickly, what other seemingly vital financial pillars might be standing on similarly shaky foundations? And sometimes it's the quietest collapses that speak the loudest. In a small Midwestern town, a century-old institution fell. We are referring to the great Almena State Bank. On October 23, 2020, Almena State Bank in Kansas failed with $70 million in assets and $68.7 million in deposits. Though small, this century-old institution had been the financial centerpiece of its rural community since 1883, surviving 2 world wars, the Great Depression, and countless agricultural cycles. The critical vulnerability few recognized was Almena's overwhelming exposure to agricultural loans in a region facing both prolonged drought conditions and plummeting commodity prices. When farm bankruptcies surged, the small bank's loan portfolio deteriorated beyond recovery. Regulatory examinations revealed that approximately 82% of Almena's loans were in agricultural credits, primarily to wheat and corn farmers in northwest Kansas. When 3 consecutive years of below-average rainfall coincided with low commodity prices, loan delinquencies surged to unsustainable levels. The bank had attempted to address this concentration by diversifying into small commercial loans in nearby communities. However, these efforts proved insufficient to offset mounting agricultural loan losses. By mid-2020, nearly 18% of its loan portfolio was classified as non-performing, an unsustainable level for an institution its size. Equity Bank assumed Almena's deposits and purchased some of its assets, maintaining a physical presence in the community. However, the acquiring institution centralized many decision-making functions previously handled locally, creating additional barriers for customers accustomed to Almena's highly personalized service model. For the farming communities of north-central Kansas, Almena's failure meant losing a financial partner that understood the unique rhythms of agricultural business. Local farmers suddenly found themselves dealing with large national banks that lacked understanding of their seasonal cash flow needs and local economic conditions. 72-year-old wheat farmer Howard Jenkins expressed what many felt. "My father banked there. His father banked there. When you lose a bank that's been part of your community for generations, you lose more than just a place to keep money. You lose part of what holds the community together." The impact extended beyond financial services to community support. Almena had been a significant donor to local schools, 4-H programs, and community events, contributions that disappeared along with the institution itself. The bank's annual agricultural appreciation dinner had been a community tradition for over 50 years before the failure ended this practice. As climate challenges continue to transform agricultural regions across America, how many other small rural banks face similar vulnerabilities? And what happens to these essential farming communities when their local financial institutions disappear? And it wasn't just the heartland feeling the strain. Along the country's coastal edges, another long-standing institution quietly went under. Let's take a look at the First City Bank of Florida. First City Bank of Florida collapsed on October 16, 2020, with $134.7 million in assets and $131.4 million in deposits. This regional institution had served coastal communities across the Florida Panhandle for decades. What few people understood was First City's dangerous concentration of loans in beachfront properties and tourism-dependent businesses, sectors devastated first by hurricane damage and then by pandemic-related travel restrictions. When tourism collapsed in 2020, the bank's loan portfolio deteriorated rapidly. For small business owners across Florida's coastal communities, the bank's failure compounded the challenges of an already devastating year. Restaurant owner Carlos Mendez described it as the final blow, losing not just customers due to the pandemic, but also his long-standing line of credit when the bank failed. failed. First City's collapse highlights the growing vulnerability of regional banks with loan portfolios concentrated in climate-sensitive areas. As extreme weather events become more frequent and severe, how many other regional institutions face similar hidden risks in their loan portfolios? And the losses kept coming. In one rural Appalachian community, another long-standing bank quietly shut its doors, leaving locals without a financial safety net. The First State Bank. The First State Bank in West Virginia failed on April 3, 2020, with $152.4 million in assets and $139.5 million in deposits. This regional institution had served rural communities for generations as a financial lifeline in economically challenged areas. The critical vulnerability that proved fatal was First State's heavy exposure to the struggling coal industry, an economic sector facing both market pressures and regulatory changes. As coal companies faltered, the bank's commercial loan portfolio deteriorated beyond recovery. For communities already devastated by coal industry decline, the bank's failure removed a crucial source of credit and financial services. Small business owner Sarah Reynolds described the compounding effect. "We were already watching the mines close and people leave town. Losing our bank felt like losing the last lifeline to economic survival." First State's failure raises profound questions about the future of banking in regions tied to declining industries. As America's economic landscape continues to transform, how many other regional banks face similar existential threats due to their connections to industries in permanent decline? And in the Midwest, financial cracks continue to widen. One small Nebraska bank, already struggling with a limited deposit base and growing loan stress, couldn't stay afloat, despite more than a century of service to its community. This is the Erickson State Bank. On February 14, 2020, Erickson State Bank in Nebraska failed with $100,900,000 in assets and $95,200,000 in deposits. This small institution had been serving rural communities since 1904. What few recognized was Erickson's critical vulnerability stemming from its concentration in agricultural loans in a region experiencing both demographic decline and economic transformation. As younger generations left farming communities and agricultural economics became increasingly challenging, the bank's century-old business model became unsustainable. For elderly residents in rural Nebraska, the bank's failure meant losing their only local financial institution. 85-year-old Margaret Wilson expressed what many felt. "I've banked there my entire adult life. Now I have to drive 45 minutes to the nearest bank branch. At my age, that's not just inconvenient, it's sometimes impossible in winter." Erickson's collapse highlights a troubling reality facing rural America. As populations decline in agricultural regions, how many other small community banks face similar demographic challenges to their fundamental business model? And what happens to vulnerable rural residents when these essential services disappear? And beyond rural towns, even mission-driven banks weren't spared. In one of America's urban centers, a historic institution serving Black communities for decades also fell. City National Bank of New Jersey. City National Bank of New Jersey failed on November 1, 2019, with $120.6 million in assets and $111.2 million in deposits. This institution had a unique significance as one of the few minority-owned banks serving predominantly African-American communities. The hidden vulnerability that proved fatal was City National's struggles with persistent operational issues, regulatory compliance challenges, and capital adequacy problems, issues common among smaller community banks with limited resources for the increasingly complex regulatory environment. For minority communities in Newark and New York City, the bank's failure represented the loss of more than just financial services. As local pastor Reverend James Thompson explained, this wasn't just a bank, it was an institution that understood the unique needs of our community, that would make loans other banks wouldn't consider, that saw potential where others saw only risk. City National's collapse raises essential questions about the challenges facing minority-owned financial institutions and the communities they serve. As banking becomes increasingly dominated by massive institutions, what happens to the specialized community banks serving populations historically marginalized by mainstream financial institutions? The failures kept piling up, each one telling a different story. And this time, this was the story of the Resolute Bank. Resolute Bank collapsed on October 25, 2019, with just $27.1 million in assets and $26.2 million in deposits, making it one of the smallest bank failures in recent years. This Ohio-based institution focused primarily on residential mortgage lending in underserved communities. The critical vulnerability few recognized was Resolute's extremely narrow business model and limited capital reserves, leaving no margin for error in an increasingly competitive mortgage market dominated by large national lenders with sophisticated technology platforms. For low-income homebuyers in Ohio who relied on Resolute's personalized approach to mortgage lending, the bank's failure meant losing a financial partner willing to look beyond rigid credit score algorithms. Community housing advocate Marcus Johnson described the impact. Resolute would sit down with families, understand their unique situations, and find ways to make home ownership possible. That kind of personal touch is disappearing from banking. What makes Resolute's failure particularly significant is how it represents the growing challenges facing the smallest community banks across America. As regulatory compliance costs rise and technology investments become essential, how many other small institutions lack the scale to remain viable in the modern banking landscape? And on that very same day, in a different corner of the country, another small bank went under. This time, it was a rural institution built to serve those left out by bigger players. But even that mission wasn't enough to keep it alive. Let's look at the next bank went crawling. Louisa Community Bank. Louisa Community Bank in Kentucky failed on October 25, 2019, with $29.7 million in assets and $26.5 million in deposits. This small institution had been founded to serve a rural community often overlooked by larger financial institutions. What few people understood was Louisa's vulnerability stemming from its founding in 2006, just before the financial crisis, and its struggle to build sufficient capital reserves during the subsequent challenging years for new banks. Without the cushion of decades of accumulated capital, newer institutions face heightened vulnerability to economic shocks. For the small Appalachian community of Louisa, the bank's failure meant losing a financial institution specifically created to address local needs. Small business owner Robert Anderson expressed the sentiment of many. They understood coal country's unique challenges. Now we're just another dot on the map to some bank headquartered in a city where they couldn't find us with a GPS. Louisa's collapse raises important questions about the future of community banking in rural America. As regulatory requirements and technology costs make new bank formations increasingly rare, what happens when existing small banks fail? Will new community banks emerge to replace them, or are we witnessing the gradual disappearance of truly local banking? If you enjoyed watching this video, then go ahead and click on any of the cards on your screen for more.
I'm very excited to introduce the new Huawei Mate X6. Ultra light and slim with diamond-cut craftsmanship and unique nebula finishes.
Huawei just dropped a game-changing device, and the timing couldn't be worse for Apple. Investors are watching closely, and the pressure on Tim Cook is mounting.
Apple is not really innovative anymore. Okay, since Mr. Jobs passed away, God bless him, they haven't done anything innovative.
The real question now isn't whether Apple is behind, but if it can catch up before time runs out. With mounting competition and growing investor concerns, Tim Cook's leadership is being tested like never before. The fall of an empire. The tech giant that dominated our pockets and defined an era is facing its most serious challenge yet. Apple, the company that revolutionized how we interact with technology, is experiencing a dramatic decline that has sent shockwaves through the industry. The warning signs are flashing red, and they're impossible to ignore. What we're witnessing isn't just a temporary setback, it's a seismic shift in the global tech landscape. iPhone sales in China plummeted by 24% in the first 6 weeks of 2024 alone. This staggering drop means Apple has lost its position as China's top smartphone seller to Vivo, with its market share plunging from 19% to just 15.7%. But this is just the beginning of a far more troubling trend for Apple. By the first quarter of 2024, iPhone sales dropped an additional 19.1%, marking Apple's worst performance in China since 2020. The tech giant has fallen to third place, trailing behind Vivo and Honor, and the data shows this collapse is accelerating. By Q4 2024, iPhone shipments declined 18.2%, with Apple's market share at a mere 17.1%. The full year of 2024 delivered a devastating verdict. Apple's smartphone shipments in China fell 17%, the largest annual decline since 2016. Both Vivo and Huawei have now overtaken Apple in what was once its most profitable international market. The catalyst for this unprecedented collapse? Huawei's remarkable resurgence. Despite years of crippling U.S. sanctions designed to destroy the Chinese tech giant, Huawei has staged a comeback that has left industry experts stunned. The company's sales surged 64% in early 2024 and climbed an astonishing 69.7% in Q1 2024 alone.
So that phone single-handedly outdid anything Apple just announced. I'm gonna be real. It just released on the 10th of September. That phone is called the Huawei Mate XT. A lot of people call it a trifold, but it only has 2 bendable places. It just gives you 3 screens, which is I ain't gonna lie. I mean, you get 3 different OLED displays. It has an 8 megapixel HDR 4K camera, and the rear camera is 50 megapixels. up to 4K, of course.
Huawei's revival centers around two groundbreaking devices that have captivated the Chinese market. First came the Mate 60 Pro in August 2023, featuring a 7-nanometer chip developed domestically by SMIC, directly defying American sanctions. This technological achievement sparked a wave of patriotic fervor among Chinese consumers.
All displays are OLED. But you know what's so intriguing? Huawei has been doing stuff like this forever. We just don't have access to it.
Then in April 2024, Huawei unveiled its Pura 70 series, smartphones that experts say match or exceed the iPhone's capabilities at lower price points. Both devices showcase China's growing technological independence and self-sufficiency, a direct challenge to American dominance in the sector.
Keith Ledzinski, a world-renowned photographer, put the Mate X6 through its paces, highlighting its color accuracy, 10 times telephoto lens, balanced focus and blur, and ultra snapshot.
The impact has been devastating for Apple. Industry analysts now predict Huawei will ship 60 million smartphones in 2024, nearly doubling its 2023 figure of 32 million units. The Pura 70 alone is expected to contribute 10.4 million units globally, directly taking market share from Apple's iPhone. But the most crushing blow came in September 2024, when Huawei launched its revolutionary Mate XT trifold smartphone, a device that makes Apple's iPhone 16 look like outdated technology from a bygone era.
Not as readily in the US. I'm not that tied to Apple. I'm in their ecosystem. I have almost every Apple product, but I'm not gonna lie, this is impressive. And it's so impressive because this company seemingly continues to innovate and give us new products. Come on, Apple, you gotta do better, man. Like, look at this phone.
Even more alarming for Apple investors, Huawei's Mate XT garnered over 6.5 million pre-orders in China, demonstrating extraordinary consumer enthusiasm despite its premium price point. This unprecedented demand shows Chinese consumers are increasingly choosing domestic innovation over Apple's stagnant offerings.
With a level of never-before-seen versatility, the Mate X6 delivers the most advanced dual-fold experience ever.
The competitive dynamics are clear and brutal. Huawei's devices mirror iPhone Pro features, such as the triple-lens camera system, but offer more competitive pricing. While the iPhone 15 starts at 5,999 yuan, approximately $820, the Pura 70 undercuts it at around $760, delivering equal or superior performance. This technological and pricing advantage has combined with a surge in Chinese national pride. Consumers are increasingly favoring domestic brands like Huawei, Vivo, Honor, Xiaomi, and Oppo, driven by advanced features, lower prices, and patriotic sentiment. In a 2023 Sina survey, 61,000 respondents preferred Huawei's Mate 60 compared to just 24,000 for the iPhone 15. Apple's challenges extend beyond competition. The Chinese government has banned iPhones in state agencies, creating significant barriers in a critical market. Additionally, Apple faces regulatory hurdles, implementing its AI features in China, while Huawei's localized innovations thrive under Chinese regulations. The consequences for Apple's global position are profound. China accounts for approximately 19% of Apple's total revenue, meaning this collapse threatens the company's financial stability worldwide. The iPhone, which generates about 50% of Apple's revenue, is facing its steepest decline in years. Tim Cook's response has been a desperate series of damage control efforts. The CEO has visited China multiple times in 2024, opening a new store in Shanghai and attending the China Development Forum, projecting optimism despite the sales slump. But these public relations moves have failed to reverse the declining trajectory. In an unprecedented move that shows just how desperate the situation has become, Apple offered rare discounts on iPhone 16 models, up to 500 yuan, approximately $68.50, in January 2024. The company even partnered with Chinese e-commerce platforms like Alibaba's Tmall for deeper cuts up to 1,000 yuan, $137, a strategy that would have been unthinkable during Apple's dominance. These price cuts signal a company in crisis, attempting to compete on cost rather than innovation, the very antithesis of Apple's premium brand positioning. It's a tacit admission that the company can no longer justify its premium pricing in the face of superior Chinese alternatives. The innovation gap between Apple and Huawei continues to widen. While Apple struggles to integrate AI capabilities into its ecosystem, Huawei's Harmony OS operating system has surpassed iOS in China's market share in Q1 2024, doubling its global reach from 2% to 4%. This remarkable achievement, despite US sanctions, showcases Huawei's resilience and technological prowess. The Huawei resurgence. The stunning revival of Huawei represents one of the most remarkable corporate comebacks in modern business history, a resurgence that has caught Western tech giants and policymakers completely off guard. To understand the full scope of this technological earthquake, we need to examine how Huawei defied all expectations to challenge Apple's supremacy. The timeline of Huawei's renaissance begins with a pivotal moment in 2019. U.S. sanctions, designed to cripple the Chinese tech giant, cut off Huawei's access to critical Google services and advanced semiconductors. Global market share plummeted from 17% to just 4% within 5 years, and many Western analysts proclaimed the effective death of Huawei as a smartphone competitor. But beneath the surface, these sanctions triggered something unexpected, an unprecedented wave of innovation and self-reliance within Chinese tech ecosystems. Rather than capitulating, Huawei launched HarmonyOS, its proprietary operating system, and directed billions toward developing domestic chip manufacturing capabilities. The first signs of Huawei's resurrection appeared in August 2023 with the surprise launch of the Mate 60 Pro. Despite sanctions blocking access to advanced chip fabrication equipment, Huawei unveiled a smartphone powered by a domestically produced 7nm Kirin chip manufactured by SMIC. This technological breakthrough sent shockwaves through the industry and sparked investigations by U.S. officials into potential sanctions violations.
Does this new chip suggest Huawei has found a way to bypass U.S. sanctions?
And in fact, the sanctions are still functioning. The sanctions were to keep China 2 generations behind, was to limit the technology that was available to 2 generations behind what was available in the West. But, you know, what had happened is that SMIC had fallen back to about 3 generations behind. And so what they've been able to do is close the gap back. So it shows that SMIC is operating a lot better now than they were 2 years ago.
The Mate 60 Pro demonstrated something profound: China's ability to innovate around American restrictions. The device not only offered 5G connectivity, but also introduced satellite calling capabilities that surpassed the iPhone 15's satellite SOS messaging features. Chinese consumers responded enthusiastically, with the device selling 1.6 million units in just 6 weeks, of which the Mate 60 Pro accounted for 75% of sales. Building on this momentum, Huawei launched the Pura 70 series in April 2024, targeting Apple's premium iPhone market directly. The Pura 70 series features advanced cameras, sleek design, and the next-generation Kirin 9010 chip. Priced starting at $760, these devices compete directly with Apple's iPhone Pro models, which cost significantly more. The technological innovations didn't stop there. In a move that left competitors reeling, Huawei unveiled the Mate XT in September 2024, the world's first tri-fold smartphone. This revolutionary device features a 10.2-inch OLED display when fully unfolded, a slim 3.6mm profile when extended, and versatile functionality that transforms from phone to tablet to mini laptop. The Mate XT represents a level of innovation that Apple has thus far been unable or unwilling to match. Despite its premium price point of around 19,999 yuan, $2,800, consumer demand has been extraordinary, with pre-orders exceeding 5.74 million units in China alone. The statistics paint a clear picture of Huawei's ascendancy. In 2018, the company shipped a staggering 372.62 million units in China, commanding 38% market share by 2019. After the sanctions-induced decline, Huawei's recovery has been spectacular. Its smartphone shipments in China surged 83% year-over-year in Q3 2023 and maintained 42% growth in Q3 2024. By August 2024, Huawei had surpassed Apple in China's smartphone sales for the first time in 46 months. This commercial success is built on a foundation of unprecedented research and development investment. Huawei has poured between $20 billion annually into R&D, representing approximately 23% of its revenue, a dramatically higher proportion than Apple's 7.7%. This aggressive investment has yielded impressive results, with Huawei holding over 120,000 active patents and securing 25% of global 5G patents. The company's HarmonyOS has similarly flourished, powering 900 million devices by June 2024 and surpassing iOS in China with a 17% market share compared to Apple's 16% in Q1 2024. This software ecosystem, developed in response to U.S. sanctions blocking Google services, has created a viable alternative that resonates with Chinese users.
Given Huawei's new phone series, how might this impact Apple's position in the market?
Probably not significantly globally. It could potentially impact it in China. If you go back 5 years ago, in 2019, 2017, Huawei was the second largest smartphone supplier.
Beyond smartphones, Huawei has established dominance in 5G infrastructure, leading globally with 70% of 5G base stations worldwide and 58% in China. The company plans to transition to 5.5G by 2025, promising 10 Gbps speeds and 100x energy efficiency improvements, technological advances that Apple, with its reliance on third-party 5G modems, cannot match. Perhaps most revealing about Huawei's resurgence is the stunning financial recovery. Q1 2024 profits surged nearly sixfold to $2.7 billion, with 2023 revenue reaching approximately $99.2 billion, 704.2 billion yuan, a 9% year-on-year increase. The consumer business alone generated $98.5 billion, demonstrating the success of Huawei's smartphone comeback strategy. What makes this revival particularly remarkable is that it occurred despite continued U.S. sanctions and restrictions. Huawei has accomplished what many thought impossible, creating a vertically integrated technology ecosystem independent of American components and software. The company has localized over 90% of its supply chain, including semiconductors from SMIC and displays from BOE. This self-reliance represents a profound shift in the global tech landscape. For decades, American technology dominance was predicated on controlling key choke points in the global supply chain. Huawei's ability to innovate around these restrictions signals a new era where Chinese technology can flourish independent of Western ecosystems.
And they were between Samsung and Apple, and that was globally. And currently they're ranked 10th according to Tech Insights. So they can certainly claw back some of this.
The patriotic dimension of Huawei's comeback cannot be overstated. Chinese consumers view supporting domestic brands as an expression of national pride, particularly after U.S. sanctions were perceived as unfair targeting of a Chinese success story. This sentiment is reflected in brand loyalty metrics, with Huawei enjoying an 85% retention rate in China compared to Apple's declining 70%. Even more concerning for Apple, Huawei's success extends beyond China's borders. The company has maintained a 10% market share in Hong Kong and is experiencing growth in various international markets through its Belt and Road Initiative partnerships. While U.S. sanctions limit Huawei's presence in Western markets, its technology is gaining traction across Asia, Africa, and parts of Europe. The implications for global technology competition are profound. Huawei has demonstrated that with sufficient determination, investment, and government support, even the most severe sanctions can be overcome. This lesson will not be lost on other Chinese tech companies or on the Chinese government, which has prioritized technological self-sufficiency as a strategic imperative. For Apple, Huawei's resurgence represents an existential challenge to its business model and global positioning. The American tech giant now faces a competitor that can not only match its technological prowess, but exceed it in critical areas like camera technology, battery life, charging speeds, and form factor innovation. Cook's last stand. As Huawei's triumphant resurgence continues to devastate Apple's position in the critical Chinese market, Tim Cook finds himself facing the most serious crisis of his tenure as CEO. The man who succeeded Steve Jobs and led Apple to unprecedented heights now stands at a precipice, watching as his carefully constructed empire begins to crumble.
Apple is not really innovative anymore. Okay, since Mr. Jobs passed away, God bless him, they haven't done anything innovative. They made a smaller iPhone, smaller iPad, bigger iPad. They've kind of upgraded Apple TV, which Jobs created. Apple Watch was created by Johnny Ives when he was still at the company when Steve Jobs ran the company. And they did Vision Pro, which has been an absolute disaster. And so part of my thesis, which is whenever a founder leaves a company, innovation dies. Will they be okay in the long run? Look, I think Tim Cook is the best COO, meaning operator, on the planet. He used to be COO, now he's CEO, of course. Right? I think he's brilliant. And I think what's going to happen with Apple longer term is Foxconn's biggest operations will end up being in India. What's going to happen longer term is India is going to become closer and closer friends with America.
The stark reality confronting Cook is captured in the numbers. Apple's market share in China has plummeted from 17.3% in 2023 to just 14% in Q2 2024. Foreign smartphone shipments, primarily Apple's, have collapsed by 47.3% year-on-year in November 2024, falling from 5.77 million to just 3.04 million units. For the 11 months from January to November 2024, foreign vendors shipped just 42 million units, a devastating 22% year-on-year decline. Even during China's critical Singles' Day shopping event in 2023, Apple's sales fell by 4%, while Huawei and Xiaomi experienced explosive growth of 66% and 28% respectively. These figures reflect a dramatic reversal of fortune for a company that once dominated China's premium smartphone segment. Cook's response to this crisis has been multi-pronged, but ultimately ineffective. His frequent visits to China in 2023 and 2024, including opening a new store in Shanghai and attending the China Development Forum, represent desperate attempts to shore up Apple's declining position. During these visits, Cook has engaged with local celebrities and developers, praised China's vibrant and dynamic business environment, and emphasized Apple's commitment to the Chinese market. More troubling for Apple investors is Cook's struggle to address the company's fundamental innovation gap. The statistics paint a damning picture. Apple invests only about 7.7% of its revenue in R&D, compared to Huawei's aggressive 23%. This disparity is reflected in patent filings, with Huawei holding over 120,000 active patents to Apple's estimated 20,000. The consequences of this innovation deficit are evident in Apple's product lineup. The iPhone, which accounts for approximately 52% of Apple's revenue, has seen largely incremental updates in recent years. While Huawei has pioneered trifold displays, advanced camera systems, and 5G technology, Apple has remained conservatively focused on refining existing designs rather than pursuing breakthrough innovations.
A lot of the production in China is going to move to India. And India, I think, is one of the most important countries on the planet. It's the world's largest country by population and the world's largest democracy.
Cook's strategy for addressing this innovation gap has centered on services rather than hardware. Apple's services division, which includes Apple Music, iCloud, and the App Store, grew 14% to $23.87 billion in Q1 2024. However, this growth is threatened by regulatory challenges, including an ongoing U.S. antitrust trial involving the company's $20 billion annual deal with Google. More alarming for Apple's future in China, recent rulings by a U.S. judge have accused Cook of choosing poorly by failing to comply with injunctions related to App Store fees and external payment options. The most significant strategic failure, however, may be Apple's delayed entrance into the AI arena. Under Cook's leadership, Apple has lagged behind competitors in integrating generative AI features. The company's Apple Intelligence Initiative, announced in 2024, faced immediate headwinds in China, where regulatory hurdles prevented its deployment until 2025. This timing gap has allowed Huawei to establish dominance in AI-driven features optimized for the Chinese market. Cook's leadership during this crisis has also been undermined by high-profile executive departures. In 2024 alone, Apple lost several key leaders, including App Store head Matt Fisher, Chief People Officer Carol Surface, and Dan Riccio, who led the Headset Group. These exits follow earlier departures in 2022 to 2023, raising questions about Cook's ability to retain top talent during a critical transition period. The financial markets have taken notice of these compounding challenges. Apple's stock experienced a 35% drop from its November 2018 peak, erasing $446 billion in value, with a 10% single-day plunge in January 2019 after a rare earnings warning. More recently, the stock fell 4% in after-hours trading following Q1 2025 earnings, despite beating overall revenue expectations due to the company's continued struggles in China. Perhaps most tellingly, Apple's response to these financial pressures has been to focus on stock buybacks rather than innovation. In 2024, the company announced a $110 billion stock buyback program and increased its dividend by 4%, signaling a prioritization of shareholder returns over long-term technological investments. The scale of these buybacks suggests a company that lacks compelling growth opportunities for its substantial cash reserves. The geopolitical dimension of Apple's crisis cannot be overlooked. Cook's frequent visits to China and public statements praising the country's business environment have failed to insulate Apple from the broader U.S.-China tensions. The reported ban on iPhones in Chinese government agencies and state-owned enterprises signals Beijing's willingness to leverage its market access as a geopolitical tool, further complicating Cook's efforts to stabilize Apple's position. The personal toll on Cook has been evident in his recent public appearances and statements. In January 2023, amid what he described as a murky economic climate, Cook voluntarily took a 40% pay cut, reducing his compensation from $100 million in 2021 to $49 million. This unprecedented move reflected both shareholder concerns about executive compensation and a tacit acknowledgement of the company's deteriorating performance. More recently, Cook has faced direct questioning about his future at Apple. When asked about his plans, he responded that it's hard to imagine life without Apple, a statement that stops short of a firm commitment to remain at the helm. This ambiguity has fueled speculation about succession planning and whether Apple's board is beginning to consider alternatives to Cook's leadership. The most immediate financial threat comes from tariffs. During Apple's Q2 2025 earnings call, Cook announced that tariffs would cost Apple approximately $900 million in the June quarter alone, assuming no changes in policy. This staggering figure, which analysts described as surprising surprisingly low given Apple's scale, nonetheless represents a significant headwind for a company already struggling with declining sales in China. Cook has attempted to mitigate these tariff impacts through diplomacy, leveraging his relationship with U.S. policymakers, including direct conversations with Commerce Secretary Howard Lutnick. Former President Trump noted in April 2025 that he helped Tim Cook recently, suggesting some success in these negotiations. However, such temporary relief does little to address the structural challenges Apple faces in the Chinese market. The most damning indictment of Cook's leadership may come from consumer perception. A growing consensus views Apple as having lost its innovative edge, with critics arguing that the company has produced no market-shifting products since the iPhone under Steve Jobs. Even the Apple Vision Pro, launched in 2023, has underperformed with slow sales due to its high price point, $3,499, and limited use cases. Customer service experiences have similarly deteriorated compared to Apple's early days. Reports indicate that simple repairs, like replacing an iPhone screen, now take over an hour and incur significant costs, compared to 5-minute no-cost replacements during the Jobs era. This shift reflects a move toward more bureaucratic processes and less empowered staff, hallmarks of Cook's operations-focused leadership style. Product quality issues have further tarnished Apple's premium brand image. Under Cook's watch, the company has faced numerous hardware problems, including Bendgate, iPhones bending under pressure, faulty butterfly keyboards in MacBooks, and iOS updates that rendered devices inoperable. Apple's initial denials of these issues, followed by quiet fixes, have eroded customer trust and weakened the perception of Apple as a company obsessed with quality. The environmental and ethical dimensions of Apple's business model have also come under increasing scrutiny during Cook's tenure. Critics argue that the company's annual iPhone releases and performance throttling of older devices encourage unsustainable upgrades, contributing to 50 million tons of annual e-waste, only 20% of which is recycled. Apple's recycling initiatives, like its Daisy robot, have been dismissed as greenwashing, particularly as the single U.S. location requires global shipping of devices, increasing emissions. Given these compounding challenges, it's little wonder that industry observers are questioning whether Cook has the vision and strategic acumen to lead Apple through this period of unprecedented disruption. The comparison to Steve Ballmer, Microsoft's former CEO, who presided over a period of stagnation, has become increasingly common, with critics suggesting that Cook, like Ballmer, has prioritized operational efficiency over groundbreaking innovation. The historical context provides further reason for concern. Apple has faced near-death experiences before, most notably in the mid-1990s, when it lost $816 million in 1996 alone, pushed to the brink by failed products and Microsoft's dominance. That crisis was resolved by Steve Jobs' return and the introduction of revolutionary products like the iMac and later the iPhone. Today's challenges are different, but arguably more systemic, involving not just product failures, but a fundamental shift in global technology leadership from west to east. The ultimate question is whether Tim Cook has the vision, the strategic flexibility, and the innovative instincts to reverse Apple's declining fortunes in China and re-establish the company's technological leadership. Based on the evidence presented, the collapsing market share, the innovation gap, the executive departures, and the ineffective strategic responses, the verdict appears increasingly clear. Tim Cook's Apple is a company in crisis, facing challenges that may prove beyond his operational skill set to resolve. If you like this video, make sure to check out the recommended videos on your screen for more amazing content.